There's no magic formula that bypasses this reality, regardless of what those clickbait thumbnails suggest. Let's break down the 3 primary paths to reaching that coveted $50,000 annual dividend income. Path number 1, the large capital approach. Starting capital, $1 million. Initial yield, 5% average. Timeline, immediate $50,000 annually. Reality check. Most people don't have $1 million readily available. Challenge. Creating a properly diversified portfolio with sustainable 5% yield requires expertise. Path number 2, the moderate investment with additions approach. Starting capital, $100,000 to $250,000, example, $200,000. Initial yield, 3.5 to 4%, $8,000 annually on $200,000. Monthly contribution, $2,000. Strategy. Follow the 60-30-10 portfolio allocation. Timeline, 12 to 15 years to reach $50,000 annually. Assumption, dividend growth averaging 6 to 7% annually. Path number 3, the small start with consistent contributions approach. Starting capital, $25,000. Monthly contribution, $1,500, $18,000 annually. Strategy, 60-30-10 portfolio allocation. Timeline, 18 to 20 years to reach $50,000 annually. Benefit, income grows steadily throughout the period. Let's run the actual numbers on path number 3 so you can see how this works in practice. Years 1 to 5. Portfolio growth primarily from your contributions. A portfolio value by year 5, $135,000. Annual dividend income, $4, 700, 3.5% yield. Years 6 to 10. Portfolio value, $320,000. Annual dividend income, $12, 800, 4% yield. Milestone, dividends now exceed a month's contribution. Years 11 to 15. Portfolio value, $600,000. Annual dividend income, $27,000. Halfway to your income goal. A dividends reinvesting at significant rates. Years 16 to 20. Portfolio crosses $1 million mark. Final value, $1.1 million. Annual dividend income, $50,000 goal achieved. Key insight, growth from dividend reinvestment exceeds your new contributions. I understand the frustration you might feel seeing these timelines. 20 years can feel like an eternity when you're eager for financial freedom now. But consider the acceleration that happens. In the first 5 years, you'll generate $4,700 annually, but by year 15, you're adding that much dividend income every 2 to 3 months. This exponential growth happens because 3 powerful forces work together. 1. Your consistent contributions form the foundation. 2. Dividend growth from the 30% portion of your portfolio compounds over time. 3. Reinvested dividends generate their own dividends, dividends on dividends. Consider this perspective. If you're 30 years old now, you'll be 50 with $50,000 in annual passive income that continues growing for the rest of your life. Still 15 plus years before traditional retirement age. Here are 4 strategies to accelerate this timeline. First, increase your monthly contributions when possible. Each additional $100 monthly can shave 6 to 12 months off your timeline. Boosting from $1,500 to $2,000 monthly might reduce your journey to 15 to 16 years. Second, in your early years, focus on higher dividend growth rates within your 30% allocation. Targeting companies at the higher end of the 10 to 15% growth range can significantly compound your income. Third, view market crashes as opportunities. Purchasing quality dividend stocks during 30% market drops means higher yields that permanently accelerate your income timeline. Fourth, as you gain experience, gradually increase your opportunity tier allocation from 10% to 15%. This adjustment can boost your overall yield without significantly increasing risk. These accelerators only work with the discipline to stay invested long-term. The biggest mistake isn't choosing wrong stocks. It's abandoning strategy too early due to unrealistic expectations. Here's a reality check. Videos claiming you can generate $50,000 in annual dividends in just 2 to 3 years starting from scratch are either assuming hundreds of thousands in starting capital or suggesting dangerously risky investments likely to cut dividends when you need them most. The real journey to $50,000 in passive income requires consistency, patience, and understanding how dividend wealth builds over time. Successful dividend investors set realistic expectations from the beginning, stick with their plan during market turbulence, and allow compounding to work its mathematical magic. While all those spreadsheets and projections might look clean on paper, the real journey to dividend wealth gets super messy. Instead of just talking theory, let's look at Sarah's actual 17-year journey from a modest $25,000 starting investment to $50,000 in annual dividend income, complete with every market crash, panic moment, and almost gave up period she experienced along the way. Sarah started her dividend journey back in 2006 at age 28, with $25,000 she'd saved from her marketing job. Following the 60-30-10 portfolio strategy we discussed, she initially allocated $15,000 to foundation stocks, $7,500 to growth stocks, and $2,500 to opportunity picks. Nothing fancy or complicated, just consistent execution of a proven plan. In her foundation tier, Sarah chose reliable companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, and Walmart, boring companies that had been raising dividends for decades. Her middle tier included emerging dividend growers like Microsoft before its massive growth phase, and Visa shortly after its IPO. For her opportunity tier, she took calculated positions in financial stocks that were temporarily beaten down but fundamentally sound. Her initial portfolio generated about $800 in annual dividends, nowhere near her eventual $50,000 goal. But Sarah understood something crucial. The journey builds a snowball that starts small and grows exponentially over time. The first major test came with the 2008 financial crisis. Sarah's portfolio plummeted 32% in value. Her stomach churned each morning checking her accounts. Her colleagues were abandoning ship, insisting this time is different and that the financial system was collapsing. During one terrifying month, her portfolio dropped 18%, leaving her sleepless and questioning everything. But Sarah made the pivotal decision that defined her success. Instead of selling, she increased her monthly contributions, buying quality dividend stocks at fire sale prices. While her account balance kept falling, she focused on her projected annual dividend income, which was actually increasing as she added more shares at higher yields. Several stocks cut their dividends during this period, especially financials. Thanks to her diversification, her total dividend income only dropped 7% in 2009 before resuming growth. This taught her to prioritize dividend safety over mere yield. In the recovery years, 2010 to 2013, Sarah maintained steady contributions. By year 5, her portfolio had grown to approximately $150,000, generating about $5,200 in annual dividends. This was mentally challenging. The numbers seemed to grow painfully slowly, while friends boasted about gains in flashy tech stocks. She sometimes wondered if she was missing out on better opportunities. Her second major test came in 2013 when interest rates rose and dividend stocks fell from favor. Her portfolio stagnated despite her contributions. After nights of spreadsheet analysis and honest self-reflection, she recommitted to her plan, knowing the long-term math was on her side. Around year 7 came the first breakthrough moment. Sarah's portfolio reached $275,000 and was generating nearly $11,000 annually. More importantly, she noticed her quarterly dividend income increasing by hundreds of dollars even without new contributions. The dividend snowball was visibly gaining momentum, validating her years of patience. Sarah's contribution pattern evolved with her career, rising with promotions, falling during a brief unemployment period, but never stopping completely. This flexibility proved crucial to maintaining her strategy through life's inevitable changes. By year 10, her portfolio had grown to approximately $490,000, generating about $19,600 annually. The psychological impact was profound. Her portfolio now produced more in dividends each year than her entire starting investment. The acceleration phase began in years 10 to 15. Her dividend income growth dramatically increased, driven not just by contributions, but by companies raising their payouts and her reinvestment of dividends. Companies she'd held for a decade were now paying 3 to 4 times their original dividend rate. Microsoft, which she purchased with a modest 1.8% yield, was yielding over 9% on her original cost basis after 12 years of increases. Her middle-tier stocks had transformed into dividend powerhouses through compounding growth. When the COVID crash hit in 2020, Sarah felt fear, but not panic. She'd built resilience through previous downturns and recognized opportunity amid chaos. Using cash reserves, she strategically bought quality dividend stocks at depressed prices, permanently accelerating her income timeline by over a year. By year 15, Sarah's portfolio exceeded $850,000, generating approximately $38,000 annually. The compounding effect was now unmistakable. Her quarterly payments increased by over $1,000 without new contributions. Her reinvested dividends alone purchased enough new shares to generate $1,500 in additional annual income. The final sprint to $50,000 happened in just 2 more years as compounding reached its full potential. By year 17, her portfolio had grown to approximately $1.15 million, with an average yield of 4.35%. Sarah's asset allocation evolved gradually, shifting slightly toward higher growth as she gained confidence, helping accelerate her timeline without significantly increasing risk. What makes Sarah's story powerful is how she navigated the psychological challenges of the dividend journey through brutal market crashes, self-doubt when others were making quick fortunes elsewhere, and the discipline required for decades of consistent investing. By focusing on steadily increasing income rather than daily price fluctuations, she built a portfolio providing $50,000 in annual passive income that grows faster than inflation without requiring another dollar of contribution. Common dividend traps that derail your progress. Sarah's success story sounds dreamy, right? But what if I told you that for every investor who reaches their dividend goals, there are 5 others who followed almost identical strategies but still failed? The difference isn't luck, it's avoiding certain dividend death traps that silently sabotage even the most disciplined investors. Let me be crystal clear. Even if you've memorized every detail of the 60-30-10 strategy and can recite dividend aristocrat lists in your sleep, you're still vulnerable to these hidden traps. I've watched countless smart people with perfect spreadsheets fall into these pitfalls, and their dividend dreams evaporated before their eyes. The most dangerous part, you probably won't even realize you're falling into these traps until it's too late. Let's expose these dividend killers one by one so your hard-earned money doesn't vanish like mine did when I first started investing. First up is the dividend tunnel vision trap, becoming fixated on current yield while ignoring everything else. When you see a stock yielding 6% compared to another at 3%, you might assume the higher yield is automatically better. In reality, that 6% yielder might be paying out 95% of its earnings, while the 3% yielder only 30%. During economic downturns, high yielders often slash dividends dramatically. My investor friend learned this the hard way after pouring $200,000 into a high-yield energy stock in 2014. 2 years later, the dividend vanished completely, and his investment plummeted 70%. This tunnel vision connects directly to the payout ratio blindness trap. Many dividend investors can quote yields and growth rates, but remain clueless about what percentage of profits their companies are distributing. Companies paying 35% of earnings as dividends have room to maintain payments during tough times. Those paying 90% have zero safety margin. During the 2020 pandemic, companies with payout ratios below 50% were 11 times more likely to maintain their dividends than those with ratios above 75%. Then there's the sector honeypot trap, creating what appears diversified but actually concentrates in just 1 or 2 sectors. I've analyzed portfolios with 15 different stocks that seemed varied, but 80% of income came from just REITs and utilities. When interest rates rise, both sectors typically suffer simultaneously. One investor's diversified portfolio of 12 dividend stocks lost 40% of its income in 2022 because 9 holdings were in rate-sensitive sectors. True diversification protects your dividend income across any economic scenario. This false diversification often leads to the concentration comfort trap. You might start with a reasonable 5% position in a dividend stock, but after years of growth and additional purchases, it grows to 25% of your portfolio. A physician I know built a $2.3 million dividend portfolio over 30 years, but allowed his GE position to reach 40% of his holdings. When GE slashed its dividend by 92%, he lost nearly half his annual income overnight. No matter how reliable a dividend payer seems, never let a single position determine your financial future. The yield drift syndrome pulls investors like quicksand toward increasingly dangerous territory. You begin with a sensible plan targeting 4% yields, spot someone bragging about their 6% portfolio, and soon you're chasing 7%, then 8%, abandoning your risk parameters without realizing it. The yield curve exists for a reason. Higher yields inherently carry higher risks. One investor started with a healthy 3 to 4% yielding portfolio in 2018, but drifted to an average yield of 8.2% by 2020. When COVID hit, his income collapsed by nearly 60% as those high yielders slashed their payouts. This yield chasing often triggers the vicious feedback loop trap, a destructive cycle between emotional trading and deteriorating results. It begins when you check your portfolio value daily and make dividend decisions based on short-term price movements rather than business quality. Soon, you're selling solid dividend growers after temporary 10% drops, then chasing whatever's currently trending. Each emotional move creates tax consequences while undermining your long-term strategy. A retiree I advised made 47 trades in 1 year, generating a $12,000 tax bill and reducing his dividend income by 15% through frantic stock switching. The recency bias blind spot makes this worse by causing you to overweight recent performance. During bull markets, you'll believe 15 to 20% growth rates are sustainable indefinitely. During bear markets, you'll expect endless dividend cuts. This trap feels like rational thinking. This stock has increased dividends by 22% annually for 3 years, so I'll project that forward forever. But economic cycles don't follow your spreadsheets. Investors who built retirement plans assuming tech dividend growers would maintain 15% growth rates indefinitely face devastation when those rates normalize to 7 to 8%. Finally, the growth myopia trap forces an unnecessary choice between current yield and growth rate. Some investors chase only high current yields and end up with stagnant income failing to keep pace with inflation. Others pursue only the fastest dividend growth rates, but generate so little current income they abandon their strategy before compounding works its magic. The solution is balance. Finding stocks offering reasonable current yields, 2 to 4%, with healthy growth rates, 6 to 12%, provides both immediate income and long-term compounding power. That's the sweet spot successful dividend investors discover, often after painful mistakes on both extremes. Alright, we've reached the end of our journey, and I hope you're seeing the bigger picture. Creating a $50,000 dividend machine isn't about overnight success. It's about building something permanent that continues paying you whether you're working or sipping coconuts on a beach somewhere. The 60-30-10 framework we've explored together has created actual generational wealth through multiple market crashes. This approach works in the real world because it builds a foundation that withstands market turbulence. Remember, dividend investing success comes from playing the long game. Like a well-built house, your dividend portfolio stands strong through storms, creating a legacy that lasts generations.